Good afternoon. My name is Campbell McCrary. I'm a Vice President, Capital Markets at Amvest Capital in New York. Welcome to the Amvest Capital Inc. live webinar with North Shore Global Uranium ETF. Trades on the NYSE Arca as URNM, Utah, Rio, Nevada, Mike. We hope you'll enjoy today's program. It will also be available in replay mode. Feel free to chat in your questions in the question pane of the GoToWebinar control panel or simply email them in. We'll try and ask the questions in real time. Amvest Capital is a New York-based specialist investment management and corporate finance firm focused solely on the natural resource sector. Do note this important disclaimer. This call is, among many things, for informational purposes only and is not any kind of advice to buy or sell securities. We're very pleased today to have with us Tim Rotolo, who is the CEO and founder of the North Shore Indices Group, as well as Lloyd Harbor Capital Management, LLC. Most recently, Tim co-founded Sachem Cove Partners, a uranium-focused investment business, and Architas Ventures. Tim leads the investment process and is responsible for all activities of the company. Tim, if you want to turn on your webcam, and we'll get started. You go through the company a bit, and if someone, guarantee if someone has found his or her way to this program today, they might want you to pull out your crystal ball regarding the uranium price and the uranium market and all that sort of thing. We'll open it up to Q&A, so please shoot in your questions, really anything related. We'll ask. So now's your time to be with one of the foremost knowledgeable people about uranium. Hi, Tim.
Hi, good afternoon. Thanks for having me again.
Yes, sir. Go ahead.
So I appreciate everybody joining us today. I'm very excited to be back in my office for the first time since March. After a week-long power outage, I have power here and air conditioning, which is really pleasant. But today I'm here to talk about uranium, and I wanted to start. I know some of the folks on the webinar are probably new. We've been doing some more significant outreach and started to see assets grow. We're up to about $11.5 million as of yesterday. Volume is picking up, so the activity in the uranium sector seems to be shifting towards the positive, which is kind of as we expected. So what I did want to do is just give everybody a very quick overview of the thesis, which I'll outline here, and then I'll just touch on a couple slides from my partner, Mike Alkin. So why did we launch this product when we did? Essentially, the thesis boils down to it being a highly contrarian asymmetric trade after a deep bear market that lasted from effectively 2009 until 2016. And our view is that bear market has ended and we're entering the beginning of a new bull market, which will be driven by primarily a significant supply deficit, which we can touch on why that's formed and why we believe that will persist until prices rise fairly dramatically. So this chart is a little outdated, but uranium prices, physical uranium prices at this point are around $32. Our view is they need to exceed $50 in order to incentivize new production. So in the last bull market from 2004 to 2007, the price rose from kind of the mid-teens to about $138 in 2007. Some of that was driven by some exogenous events which occurred, which are not too dissimilar from what we're seeing now with COVID, albeit the specific details are different. They had to do with floods and not pandemics. But not dissimilar in terms of the backdrop that we started with in 2004. What happened? What occurred after the price peaked was that you saw the nuclear event in Fukushima, which further drove sentiment and also the price of the equities. And the price of the equities dropped, well well north of 80%. In some cases, you can go back and you can look at the performance of the Global X URA, which unfortunately for them launched right before that event. And so those equities declined in excess of 80%, and the number of mining companies dropped from about 500 to closer to 40 where we are today. And actually, we're starting to see a rebound in the capital formation, and we've seen a few recent IPOs and some deals over in Australia where Australian listed companies are actually buying US-based assets in order to get exposure to uranium. On the demand side, you saw a dramatic drop-off in demand post-Fukushima as Japanese nuclear fleet was taken offline. Now we're beginning to see, again, a resurgence and maybe actually a renaissance of nuclear power as more environmentalists and politicians recognize that nuclear power is, in fact, a carbon-free, green source of electricity. And so effectively, where our thesis and where our interest is and why we think there's an asymmetric opportunity is that mining of uranium is uneconomical at these prices. Miners can't make money at $30. Even the best miners in the world, so Canadians in the Athabasca or the Kazakhs, they just can't produce profits at these prices. And so what you've seen, and we can get into deeper in a few slides, is a dramatic shift and reduction of supply. So I'll highlight a couple of slides from the Sachem Cove deck, which is, I think, very aptly named "Price is Everything." And ultimately, that's what the thesis here is. Price has to rise in order to incentivize production, or you have staggering deficits. Many of these mines are actually in depletion mode. Well, we can touch on that when I talk a little bit about the portfolio. But these mines are not coming back. These pounds cannot be brought back online, while some of them can, like the MacArthur River and Langer Heinrich. Again, you start to see in 2017, 2018, the dramatic cuts that the Kazakhs and Canadian miners and several miners in Africa began to start. And again, price is everything. That is the thesis here. On the demand side, I'll show just one quick slide on demand because I think it's important to understand that. But the World Nuclear Association in 2019 effectively projected that this is one of the strongest periods in demand. Demand growth is about 1.9%. So that part of the thesis we feel very comfortable with. And the, I think with the backdrop for nuclear power and the extensions that we're seeing in the United States, that is not the potential risk to this investment thesis. So just going back, highlight a few. How do you actually play it? So we created URNM to be a highly focused uranium mining play that would have a high correlation to the price of uranium when it does rise. As noted, we think the price needs to go from the low 30s into kind of the mid 50s to high 60s. Historically, that is overshot kind of the marginal cost of production. So we wouldn't be surprised if the price did exceed that initial target. As noted, the AUM is right around 11.5 million. So we have 375,000 shares outstanding. Average volume has increased to almost 11,000 shares per day, so liquidity is picking up. So what's really differentiated about our ETF versus some of our competitors is starts with the proprietary universe of the equities that we're actually selecting from. So we were trying to really express a fundamental view through the universe of equities that we choose. So we're always looking at the new companies that are being brought public, but also looking at what's happening with companies that are listed but may have maybe changing their focus. A good example would be Energy Resources of Australia, which we chose to remove from the universe as they're winding down their mine. And also they did a very large rights offering, which kind of skewed the market cap to be very significant. You can see that in some of our competitors' index, where it, in our opinion, has kind of an outsized weight in their index. We've excluded that position from the portfolio. So very simply, we start with the proprietary universe. Securities have to have a market cap of greater than 25 million, and then we split the portfolio into two buckets. One is focused on miners of uranium, and the other is focused on physical proxies, of which there are two. And the idea there is to provide some stability and potentially lower volatility, as those physical proxies just don't have the same level of volatility as the miners do. So they slightly less upside, but less downside risk. And actually, we think those are very interesting because they trade at discounts today to their net asset values. And then beyond that, all the components are market cap weighted. So recently there was a change to the ETF rules. It's called 6C11. That has allowed us to make some alterations to our methodology in order to, we think, better align it with the focus on junior miners and being a pure play or highly focused play on uranium mining and uranium, physical uranium. And so that process began in 2019, but we were actually able to implement some changes to the methodology beginning on June 30th with our quarterly rebalance. Then we have effectively removed any non-pure play companies which were originally in the portfolio in order to provide additional liquidity. And effectively 6C11 had some arbitrary rules around liquidity constraints and volume and market cap constraints. So you'll see we've effectively removed those from our methodology and are back to being a pure play. And I'll show you from a visual perspective what that's meant to the portfolio. So you can see our beginning portfolio that the fund started trading December 3rd. So that portfolio reflects the September 30th allocation or weightings. And you'll see the red are changes that were made as a result of companies coming in and out of the market cap thresholds. So that was Laramide in December, and NYSE Arca in December actually exited the portfolio as a result of being below the market cap threshold. Same thing happened to Bannerman Resources in March when Laramide was added back and ISO Energy was added. And then in June, we actually removed two of the pure plays and also Energy Resources of, one of the pure plays, Barrick Gold and Energy Resources of America. That capital was then reallocated pro rata to the other positions. And you can see the increase of the junior miners over that time frame. And then in July, we did a special rebalance to complete the process of excluding the pure plays, and BHP and Rio Tinto were removed from the portfolio, and we were able to further increase the allocation towards over 50% in junior miners. So as it stands today, we have, the way I think about it, is a highly stable portion of producers and physical proxies, which represent about 46% of the portfolio. And then the balance of the portfolio, around 54%, is near-term producers, developers, and explorers. And we think as a highly, one of the differentiators between us and our competitors today is effectively the way that we've allocated the capital within the index to the parts of the market that will participate or provide the most upside appreciation if, in the event that our macro view is right and the price of uranium does double or more. So here you can see the rest of the portfolio, again, highly tilted towards these smaller cap, micro cap companies, which we think are the most exciting part of the market. And anyone that you speak to about the prior bull market will tell you that the upside appreciation really came from these types of stocks. So just to summarize, our view is there's a large multi-year deficit that's formed, and that needs to be effectively solved for with a dramatic price rise in physical uranium. One thing that we didn't touch on is one catalyst that exists is that utilities need to enter into new contracts soon. So unlike other commodities, uranium utilities actually, they don't just go and buy spot price uranium. They enter into multi-year contracts so that they have security of supply. And that process has effectively, those contracts have rolled off over the last several years. Many of them were signed in the 2007 to 2010 timeframe. That new contracting cycle needs to begin relatively soon, and we think that will be one of the catalysts that actually drives prices higher. There's been a series of both U.S. political and geopolitical events which have potentially delayed that process, but we think those are kind of coming to an end, and the contracting process can begin in earnest. URNM was set up in order to provide a simple, diversified option to investors to be able to participate in what we think is a beginning of a uranium bull market. So I can leave it there, and we can take some questions.
Right on. Got a few that have come in. Thank you, everyone, for sending in some of those great questions. And here's one. As the bull market moves on and more less than ideal uranium companies come into play, does North Shore have discretion to avoid these, or are there requirements to bring them in?
No, we have full discretion to be able to add those to the universe, and then they would have to still meet the selection criteria. So we'll be evaluating all the companies that are entering the market, but I think we're highly cognizant of some of the companies that are kind of being set up as really to participate in the bull market, but not necessarily owning quality assets. So we are cognizant of that.
Can the spot price to an adequate level to incentivize mines returning to production, starting up new mines on spot transactions alone? Or does it require the volume of term contracting to significantly move the spot price to adequate levels?
Can you say it again?
That's a good question. I just got it on my desk. Can the spot price rise?
Or independently? Is that the question?
I'll read it again. Can the spot price rise to an adequate level to incentivize miners returning to production or starting up new mines on spot transactions alone? Or does it require the volume of term contracting to significantly move the spot price to adequate levels? Kind of chicken and the egg of spot price and contracts.
Yeah, I would probably defer to our domain expert on that. I mean, it seems like a highly technical question, but they should be sufficiently tied at the hip. But yes, I would agree. It's more of a chicken and the egg question issue, and I don't have a great answer. But I can, if you want to ask that person to reach out to me directly, I'd be happy to get them a more detailed answer.
Okay, we'll move on and defer to my colleague Gabe.
Sure. Thanks, Tim. Thanks, Campbell. Just some more audience questions. Could you please speak a little more on the all-in sustaining cost of producers and why $50 per pound incentive existing idled $50 pound incentives will bring supply back online as well as new mines? So I guess the question is the $50 a pound incentive price. How do you get there?
Again, I think that's a highly technical question for this forum. But I mean, I think if you look at the cost of production, even what the producers have said in terms of their ability to produce profits, they need a sufficient margin in order to be able to turn those mines back on, and they've been pretty explicit that even at the $30 price level, it's not sufficient for them to bring on production. Right? I mean, I think Mike has some good adages about you can't run a mining company if you can't make money. Sorry, I'll have to go back and find the exact language, but effectively, you need the high enough price. Just because you have a price that you can produce profits at, you still need enough to run the whole company, right? So just just the cash cost is not sufficient.
Right. I just did some math while we were here, while you were chatting as well. So last time you were on, I guess the day after was June 11th, and from there until now, you have about a 15% increase in URNM price. And then the other one that I track is the VanEck market vectors, which is only up 3%. The composition is different. I just kind of want to understand, and it's maybe the main reason why you're buying URNM is that outperformance of multiples to whatever else is out there. I'll mention the spot price was down from that same period. So you're up, spot price is down, benchmarks are up modestly, but you're up multiple times. Can you just kind of give us succinctly the value prop, and why do you think that will continue, that sort of outperformance will continue?
Yeah, I mean, I think a lot of it has to do with the security selection in the universe, but then also the portfolio or the index construction and the way that we've gone about trying to emphasize some of those smaller companies where we think there is actually more upside, right? They're the more disconnected part of the industry, partially because they're less followed. NLR, which is the VanEck product, I believe has a significant allocation to utilities. So, part of it is not necessarily, what it's, we don't own those securities, but things that they do own can often be a drag on their performance. But I would say even, if you just took the pro rata uranium portfolio, we would have probably outperformed that. And that's a good example in the, in the Global X product. My expectation, well, I don't know what will happen after the rebalance, but we just own a lot of the securities that they don't. And I can't tell you exactly what goes into their universe selection. But we've just owned several of the securities that have done quite well, or had higher weightings to things, the securities like Denison, like Paladin, that have performed quite well since June, despite the pullback in the spot price, as well as other things, other stocks like Lotus and ISO and Encore.
Right. Okay. So yeah, not all ETFs are created equal. Yeah.
And we don't have as big a weighting to Cameco, which has probably been a drag since their earnings.
Right. Okay. Thanks.
Can you comment on why the spot price is not seeing larger movements? And this question was kind of referring to the imbalance, COVID, big buying of Cameco and others in the spot market.
Yeah, I don't have a strong opinion as to why the price isn't going up more.
How big?
Yeah.
Go ahead.
Yeah, I don't have a strong opinion about why it's going up. I mean, it had a pretty significant move off the bottom. I can't tell you why people are buying in the spot market, right, or driving the price up.
And and let's say if someone said he knew or she knew, maybe they were not making it up. So
yeah, I mean, listen, the one thing I would say is that's I think there's always been a view that that's not always the best indicator, but there's been a lot of there's been a long period of time where there's been a lot of kind of fundamental improvement without the spot price being reflective of it. So therein lies part of the opportunity here, is that the feedback loop to prices isn't quite as direct as it is with other commodities.
Yeah. How big is the uranium mobile inventory that is available for spot, and where is the secondary supply coming from? You've covered some of that, but
again, I would say that's too technical of a question to get into. That's
sure. And finally, when can long-term patient investors in the uranium sector expect true price discovery to occur and uranium equities to increase in value? Well, that's we all wish that, but any comments on that sentiment? Yeah, I would just say.
Yeah, I think my only comment is the industry has continued to work through a lot of kind of overhangs, if you will, right? First with 232, now with COVID, and I think this is one of the opportunities here is that if you just look at gold and silver, right, the moves can be violent to the upside and the downside, but sometimes you don't know what's going to move the industry. You don't know what the event is ultimately that's going to cause that repricing. And again, I think that's why this is such an asymmetric trade, is we don't think that the fundamental value is reflected in the securities. And so it is somewhat of a waiting game where you need to sit there and wait for the rest of the investment world to appreciate what it is that we see here. And part of that is just, again, that even the information about the industry for a long time, up until some of the the uranium dedicated hedge funds have started kind of spreading the news about what's really happening from a supply demand perspective, was driven by one party, and they created kind of this big closed loop of information which was not entirely accurate. And so I think with some of the more publicity, although it's a very small community of people sharing information, but I do think that as the WNA has kind of had more positive information or more positive projections to make, there's a little bit more publicity between podcasts and webinars like this of people having an interest in uranium. That's what's going to take, and then what that ultimate straw is that breaks the camel's back is very challenging. I mean, I think that's really the biggest psychological challenge of being a contrarian value investor, is being willing to wait for that turn, but you have to be there for it to happen. And I would point to precious metals this year as a perfect example.
What is the base case? What is the bear case to this thesis? I guess what could go wrong?
I wouldn't necessarily call this the bear case, but I would call this, the big tail risk is that there's another nuclear event like a Fukushima. I think that's a very low probability, but it's always a risk. I think the bear case is that there's some massive inventory out there hiding. I think the other bear case is potentially on the demand side. Something happens in China, and their projected demand growth doesn't meet expectations. I still don't think that necessarily addresses the supply deficit, though. Or even I think some significant technological breakthroughs. I was having this discussion with a professor of nuclear physics, and they brought up a couple of different new technologies, and I think it's an issue of time frame, right? So thorium or molten salt, those are really interesting, but the time frame for this trade, for this investment opportunity, is measured in years, whereas some of those technologies actually having critical mass are probably measured in decades.
Okay, thank you.
Can you talk a little bit about the sort of your goal in terms of like the AUM? You mentioned you've had some increase in AUM recently. Can you talk about sort of some internal goals you have for that, and how you plan to achieve them, and then any sort of institutional interest that you've received so far?
Yeah, I mean, I think the institutional interest is that the fund's a little small right now, but people are certainly attracted to the way that the index is constructed, and certainly the thesis, I think, resonates with lots of investors. I think everyone, there's certainly some some frustration with how long it's taken for the thesis to play out. But again, I think actually that's part of the opportunity here is, there have been a lot of folks that have been burned by, kind of the false dawns in the past. And so those who have kind of either come to the sector more recently don't necessarily have that bias. As far as, goals, I want our fund to be the best performing ETF for the uranium market. That's the primary goal, right? Create the best portfolio construction, index construction that drives performance and allows people to participate in this market. If we get to 50 million by the end of the year, I think that would be great. There's some benefits for investors. Scale should beget liquidity. Liquidity creates the opportunity for there to be options, which allows people to have kind of a, just an ability to hedge, should they want that. But my view is that what's happening with Global X is a really positive development for everybody. I think that will bring more liquidity to the sector, more interest to the sector. They have a huge sales team, and a rising tide should lift all boats. And ultimately, when investors look at our ETF versus their ETF, that's where performance will matter, right? So if we can get to 50 million, that gives us access to a lot more conversations with investors to be able to tell the story to a much broader array of advisors. And that's, from a business perspective, that's the objective, but also, I think it's a huge win for the sector to just have more eyeballs, right? I think one of the challenges that's faced the uranium equity market has been that it's so small that it can't attract interest from generalist hedge funds or large mutual fund complexes. So as it begins to move up from 15 billion to 50 billion back to 100 or 150 billion, that market cap I think will just naturally attract more investors, and it will make it an easier conversation for advisors to have, and hopefully we'll be a part of that growth and make people money along the way.
Right, I guess that's the main objective. So the state of the market today is sort of one that's underfollowed, and with that comes sort of a liquidity. Are you concerned at all with liquidity in these positions that you're taking, and how does that affect the fund makeup, NAV, etc., as you start to grow?
I'm at this point, I'm not. I mean, I would tell you when we first started exploring this concept and we were talking to the mutual fund trust or the ETF trust board, it was a major concern of theirs, and that's why we had Barrick and Rio and BHP in the portfolio. I have a lot less concern about that. Certainly, if we went into a deep, broad market sell-off again, these are less liquid securities, certainly, but they all trade every day and they all price daily, so there's no issues with the NAV. And my view, and the exact comments that I made to the board at that time was, we're at the bottom of the cycle at this point, and liquidity will come back, and it has, and you've seen volumes increase pretty dramatically. And I don't know if that's a function of us and Global X being a bigger part of the market, or it's just a broader interest. But at the same time, you'll see more capital formation like we've already seen. Standard Uranium, baseload power, these are small cap companies, but more capital formation will create more diversification in the portfolio. And I think all of this goes back to the original thesis that I had from a business perspective, which is that the market was in this big negative feedback loop, and you need to find ways to break it. I think Global X, what's happening with Global X, I think will be a really important part of breaking that. And them having inflows and us having inflows are all very positive signals for the market. And ultimately, I think those are the types of things that the broader generalist investment community has to be able to see in order to really take notice and want to spend time on the sector.
Yeah, And yeah, I honestly I see Global X sort of liquidating a couple funds every at least last couple of days. News has been out. They've been liquidating a couple funds. So interesting to see that transition and see what happens with the uranium piece for sure. Sorry, Campbell, go ahead.
Oh yeah, I was going to say, are there any plans to offer this for non-U.S. investors? What could a Canadian say practically want to be able to buy this from a tax and point of view and all that, or listing? Do you have international plans?
As far as I know, international investors can buy it today if they have the right accounts. We have certainly thought about launching a dedicated European product. I think we want to see this fund get to critical mass, 50 to 100 million, just to have, proof of concept. But we certainly have seen demand from, around the globe.
Yeah.
So it's absolutely on the drawing board. I would say it's a lower priority. Yeah.
Right.
Yeah.
Good.
Yeah. So we actually have a relationship already in place that can help us to expedite that process. But just from a priority standpoint, our view is this is a great place in it. The NYSE is a large market, and arguably, we can probably capture a significant portion of the global investors with just this product.
I guess how the upcoming elections, U.S. elections, how much of that, if at all, of uncertainty and different administrations is weighing down on the industry and market valuations? Do you want to wade in that, or we'll see?
Yeah, I don't have a strong view. I mean, I guess Biden had some comments about the uranium mining in the Grand Canyon, but a lot of that stuff is a sideshow. I mean, that's not going to move the needle. Even the stuff about a strategic reserve for the United States, in some ways, is it's a de minimis portion of the global supply demand. What I guess could be concerning is if Biden and Biden wins, number one, and he decided to do something really drastic and trying to shut down the whole nuclear power. But it seems like they're going in the opposite direction right now. If anything, I think between ESG and just the kind of concerns around climate change, nuclear has now become part of the discussion. So I feel like there's actually somewhat of a positive sentiment tailwind for nuclear
his former
demand.
boss made some very positive comments about.
Yeah.
So
yeah, I mean, so again, demand is very important, right? But we feel like that's the kind of understood heart of the thesis here. I think the misunderstood component and the disconnect is that people are missing the supply deficit and how drastic that is, and that that's where I think the opportunity exists. But yeah, certainly we want there to continue to be positive sentiment around nuclear power. Certainly don't want there to be any events, but it feels like there is a real resurgence globally. And I think whether or not it moves the needle for the nuclear power industry, the ability for the United States to start exporting nuclear technology, I think, is very interesting from a geopolitical standpoint. Again, how these things impact global supply demand in the short term and whether or not that's impactful to the equities, I think that's always challenging to say. But directionally, I think the path of least resistance is for continued demand growth, and until prices rise or the thesis is proven incorrect, that there is not actually a significant supply deficit, I think that the thesis remains intact.
Thank you.
Tim, I just have a question before we close here. We did this one a couple months ago. Assuming we do this one another couple months from now, we're going to be closer to November. And, just for the listening audience, which is, also very US centric, do you have a view on whether uranium moves one direction or another depending on which party comes into office in November?
I don't think so. But I mean, my view is that it should not be correlated one way or the other.
Sure. Okay.
At least not causally. I guess there's certainly some, it's possible that there's the election goes one way and the price goes one way, and but no, I mean, I'm not in general. I'm not overly focused. I think other parts of the market probably are much more sensitive to the outcome of the election, things like biotech or even big tech, with whether or not it gets more highly regulated.
Okay.
I lost you guys.
Yep. No,
Nope.
we're here. Thank you. Appreciate that.
Want to thank everyone for tuning in, and please, we'll be queuing you for feedback. Please share a few lines. Really important and helpful for us and for the company. And please follow North Shore. They've got quite a bit of a presence on Twitter and LinkedIn and all the usual places. And so you can keep up with their thoughts on the market and musings there. And look forward to seeing you at another event. So we'll move Tim for a closing statement.
I really appreciate everybody's attendance, and to the extent that you have questions, you can find my email address on our website, URNM ETF.com. Again, we think there's a significant opportunity in the uranium market due to the supply deficit which is formed, and prices need to rise, and we think the fundamental backdrop is the strongest it's been since we've launched the fund, and probably in the last 5+ years. So we think URNM represents a easy to access diversified play on the sector, and it re-rating as a result of the price rise in uranium.
Mm-hmm.
So thank you.
Great. Thank you, everyone.
Thanks a lot, Tim. Thank you.
Talk to you later.